topic today is focused on something we've seen a lot of in the news as it's hit the center stage amongst our world backdrop, infrastructure investing. Topical on a whole number of fronts right now. I'm not the expert in this space. I'm very pleased to be joined by Dave Wahl, Director and Portfolio Specialist with ClearBridge Investments, now a wholly owned subsidiary of one of the world's largest asset managers in Franklin Templeton. Dave, thanks very much for joining us today.
Thanks for the opportunity to speak. And again, appreciate everyone taking the time out of the day to perhaps, I hope, to better understand the infrastructure story when we're all through here.
Brilliant. Well, one small housekeeping matter to take care of before we get into it. We've got you for the next half hour. Questions from our audience, feel free to fire them into the Q&A box, and Dave and I will work through those in step. If not, we'll leave some time at the finish line for anything that we don't manage to weave into the conversation today. So ask away, we'll be ready for you. Then to the main event, Dave. Everyone's talking about infrastructure right now. Areas we've underinvested, missed out on, or forward-looking investment ideas based on evolution or change in geopolitics around the world. It all seems to point back to infrastructure at the moment. So maybe first loaded question out to you. Why is it such an exciting investment opportunity in this environment, and what are you looking at?
Well, exciting is a great term, I think. But listen, before we get started, I just wanted to talk to everyone briefly about how my day's gone. So my alarm went off way too early this morning, and the first thing I did was turn on the lights. I went to the washroom to splash some water on my face and noticed that the gas furnace was running because it's a little cooler than it has been overnight. I went downstairs, made breakfast on the gas stove, hurried upstairs for a shower, as I always am running a little bit late, got in the car, took the 407, just outside of Toronto, to the GO station, took the train to my first meeting, and as I did, I went directly by the airport. Seems normal enough, boring, yes, right? But I just asked that question because I want to know what does my entire morning routine have in common? Well, each step of the way involves some form of infrastructure: electricity, gas, water, toll road, rail, airport, all infrastructure assets that a listed portfolio, such as the one we're talking about or the one that's available at Franklin Templeton, you could invest in. So really briefly, infrastructure are those physical assets that provide services for us that are essential to live our lives. These are services we use and interact with every day. I said, for instance, gas, water, electricity, those just to carry out our daily routines and activities. And we also use the other infrastructure that I talked about, airports, railroads, to move people and goods from location to location. The good part about infrastructure is that no matter if markets are in a boom or in a bust, we generally interact with these essential services every single day, as our demand for those services, they really remain fairly constant. There's little impact to fundamentals when it comes to uncertain economic conditions or even a downturn in the market, as we're potentially going through today. So that being said, why is it a good solution as well going forward? There's many issues, I think, that are contributing to investor angst right now. Uncertain economic environment, inflation, interest rate increases. You talked about geopolitical uncertainty globally. All this is a perfect storm for infrastructure. Many headwinds for other investments are tailwinds for us, and it can solve for a ton of issues. Income, stable and predictable income, inflation hedge. 90% of the names we invest in have some sort of inflation hedge, preservation of capital. Over a 10-year period that we did a study up until the end of 21, we get 80% of the upside, but only capture 45% of the downside in the market versus global equities. And then that leads to reduced volatility. So I like to talk about it. It's not just a product, but it's really a solution in these, kind of crazy times that we're involved in.
Interesting. So you mentioned a lot as far as infrastructure that we touch that you perhaps don't think about intuitively on your way out the front door on a daily basis, whether you're running errands or going to work. You also mentioned kind of a time horizon on things, and you've given us a bit of a view on the short term on infrastructure and things that I think everybody in our audience has perhaps felt the pain of over the last couple of months, whether it's gas prices going up or other kind of inflationary items affecting our day-to-day lives. Is it a good long-term bet in your eyes?
Yeah, and I'll try to use a couple of visuals as we talk about this, as we had discussed some of the topics maybe earlier on, but I'll just put this up for the people on the call. Let me just give you a quick overview of why invest in infra in the long term, and we'll expand on that as we talk later on. I have some other, more, topical things around the Inflation Reduction Act, et cetera, that might help people understand a little bit more, but I'll give you a quick overview. So one, there's a significant growth in assets globally from both emerged and developed markets. A lot of people think this is an emerging market story where there's urbanization and the increase in wealth of the middle class leads to infrastructure build out for those urban areas. That's true, but it's also a developed market issue about maintenance, improvement, capacity, capacity upgrades, all of those things. And a study we used from Hale Economics from now 2014 stated that assets were expected to grow from about 50 trillion in 2014 to 110 trillion in 2030. And if that's the case, private sector's got to play a much larger role. The governments, with all the government constraints, governments used to be able to build infra, had a difficult time maintaining it. Now they're having a difficult time maintaining it. So it's going to take the private sector to help out a lot. Energy and transportation are going to drive the growth, and that is really the listed sweet spot that we're talking about today. And we've all heard the stories about green stimulus around the globe. That's going to encourage renewable investing, and the adoption of net zero 2050 is going to be a huge driver as well. So I think that encapsulates the growth side. On the other side, infrastructure provides stable and predictable income and growth. And that's because cash flows are underpinned either by regulation or a regulatory environment or board, or long-term contracts in the case of the 407 just north of Toronto. And most revenues, like I had said, are linked to inflation. So you get that inflation hedge, especially in times like this. It's another bolt-on advantage to having infra. And finally, the asset class provides great diversification for your equity portfolio. It has a lower correlation to most asset classes. And I talked about the upside downside capture. It's really a chance to de-risk part of your equity portfolio for the long term. I'll just go one slide here, just sorry to interrupt, Eric, but just to show that it's a great long-term investment. I'm going to just show you this, and the two lines to be important. It's a 10-year study to the end of June this year. The two important lines are the teal line, which is an infrastructure and proxy, which is our mandate, and then the MSCI index, which is the orange line. And you can see over the long term, infrastructure is a great long-term performer, regardless of the conditions that we're involved in.
And it looks more stable, certainly, than an equity-only market at this stage, which perhaps is a testament to the portfolio itself. Maybe sets up well for the next question. Ultimately, you've got the fund listed in Canada with Franklin Templeton as FCII. Can you explain to us a bit? You highlighted priorities that were important things to consider for investors. How have you set up this fund in particular to capture the opportunity for Canadian investors?
Okay, let me try to use one visual around this. This will kind of be the talk, and I'll kind of start about our philosophy for infrastructure, because it's not apples to apples. It's not the same for everybody doesn't view infrastructure being the same set of names globally. So from our perspective, our philosophy on infrastructure is that we believe that infrastructure assets, and that's regardless of whether they're listed, and that's in the public market, which our fund is, or unlisted, which are those private companies, they exhibit the same characteristics and cash flows. So we just believe that by us using a longer term fundamental valuation approach, when we're investing in these listed markets, there's mispricing that occurs in the infrastructure assets, and generally lower than they should be in the short term. So by accessing those markets, we view both the ability to get in and out of the company and the number of companies to invest in is greater, and that allows us to have further enhanced returns to the investors. And really, we'll consider a company, for everyone's sake, we'll consider a name if the company owns a hard physical asset that provides an essential service to society or an economy. And finally, there's got to be a framework in place to ensure that all of us, the investors, are adequately rewarded. And again, that goes back to the framework being either regulatory in nature, and that has set a regulated return on investment, or based on those long-term contracts, meaning you have long-term control of an asset at a stated return, after which time it's sent back to the owner. And the owner is usually government in the case of an airport or a toll road. And both these structures provide visibility over the company's ability to generate cash flow. The funny thing is it, like I said, infra is not apples to apples when you come to investing. There's no universally agreed upon definition of infra, but from our perspective, and this is relative to indices and maybe other managers, we have a more focused view on what constitutes infra. We regard pure infra assets with monopoly characteristics, long life assets, and relatively stable, predictable cash flows. So when you look at this chart, our definition of infra will be described as core, and that's comprised of the two buckets in the middle of the slide. So from a regulated asset perspective, and that's poles, wires, pipes, really transmission and distribution of utilities. They're defensive assets. They have higher income, low GDP exposure. And from our perspective, Eric, we always have a minimum of 50% to the regulated asset side because we're trying to preserve capital on the downside as our first priority, keeping risk in mind all the time. The other bucket we consider are the user pay assets. And those are the traditional ones that I talked about earlier in the call: roads, rail, airports, really transportation, and they're more growthy. They have a lower income component and leverage to GDP. But more importantly, what do we exclude? Well, community and social, they're government-backed, long-dated, low-yielding. There's just not many opportunities for us in the listed space, so we don't involve those. But most importantly for us, competitive assets, the far right-hand side. And that's, again, to reduce volatility and maintain stability of cash flows. Those are unregulated assets, names that have supply-demand risk, construction and service companies, no hard asset cash flows, energy retail, unregulated generation, MLPs. There's a long list. But just for purpose sake here, we invest in regulated assets and user pay assets.
That is actually fascinating, and you know, for our audience, I hope you were paying attention because Dave just dropped a boatload of information in front of you, and there's a few things that I want to kind of feed in next. You mentioned you're looking at individual companies and you've got a framework, obviously, to look at those. You also mentioned at the tail end, you know, obviously there are other ways to invest that can involve indices, but your fund is actually actively managed. And I'm confident, given the knowledge that's coming out of your brain right now, you've got a really good reason for it. Why do you think you need an active strategy for infrastructure in particular?
Well, being an active manager, there is a true belief in that, obviously, but many, many reasons. But in interest of time, I'll just talk about a couple of things here. So for the people on the call's sake, there's times in the economic cycle, perhaps now, when managing to a benchmark just doesn't make sense to us from an intuitive perspective. So we're benchmark unaware. We're really trying to target G7 inflation plus 5.5% over a 5-year cycle. So breaking that down simply, it's just 5.5% real return over 5 years. And what does that do for us? It really ensures that the focus of the portfolio construction remains on delivering consistent, absolute, real returns and avoids any of the risk that you may have by straying towards relative performance against indices. And you know what? That can really adversely impact stock selection over the long term. For instance, having to be heavily weighted to North America or gas when it isn't prudent, that's things that we get to avoid. It really gives us a flexibility to manage through changing economic environments. We can go up and down the market cap spectrum or dial up or down the economic sensitivity. And I'll give your crew an example of that. In March of 2020, when things were starting to slow down, we didn't predict the pandemic. So don't anyone ask us about that. We just believe that we were near the end of the business cycle. So at that moment in time, because we were benchmark unaware and because we were looking for absolute returns, we were able to take approximately 85% of our mandate and put that in the regulated assets, which was more defensive, more higher income. And that proved very well versus some of the benchmarks in the industry. We had a tremendous outperformance in 2020.
So if I kind of put it back at you, you get to use your brain, your research, your intelligence, all the information you as an active manager have at your disposal across your network and your people to make an informed investment decision that's not beholden to quarterly, annual rebalances where you're just having to track a goalpost at the end.
Yeah,
Gives you a lot of freedom.
That's correct. You should have answered the question, Eric. It was better than mine, but
No,
yeah.
I think our audience liked yours for the details. Just make sure that hit the point home, as
Yes,
the saying goes. So, infrastructure performing in different environments. You hit a key one, obviously, and sounds like you had a good move in 2020.
right.
Thinking about differing environments and the world we're in now, where there's a lot going on in the world and a lot of different things to factor in and consider. How do you actually manage what could become an opportunity for you in the fund?
Right. So this slide kind of gives examples around that. And again, this is all from, and you say it well, it's through our intellect and through our experience and knowledge and expertise around infra. We are the largest global listed infrastructure team, and we focus only on listed infrastructure, not the unlisted or the private companies, not infrastructure debt, just the markets of all the infrastructure names, of which we take about 170 to get into our universe. So we take it from a valuation perspective. So our valuations will tell us where to be, but using macroeconomic inputs like in-country GDP, CPI, short, long-term rates in every country, that feeds into our valuations, and that helps us understand where we are macro when we're doing it from a bottom-up perspective and putting those scenarios into our cash flows. So I just put this slide up so people can see by example. If you're looking at different outcomes and different scenarios of what's going on in the marketplace, and I'm just going to move my little screen over a little bit. So market expectations. If you're declining growth and inflation, that will be a rotation away from the economically sensitive infra or the user pays, and that'll be positive for utilities. So that would be something where we would be right now, and not coincidentally, I guess, we are moving towards being less risk and more into the regulated assets bucket, over 70% again, as we move forward to a nearing the end of the business cycle or maybe a recessionary environment. Conversely, running hot, that's a high growth, high inflation example. Bond yields will be higher, and that'll weigh on utilities for a little while until they can catch up on costs. But in that case, infra, and I mean user pays, will do very well. And so we would, again, gear the portfolio more towards those user pay and GDP sensitive assets. So it goes back and forth, Eric, depending on where we are and our valuations and those macroeconomic inputs. But that's how we manage the process in different economic scenarios. It's a good question.
I think it's important to share it and highlight it, especially as an active manager, ultimately knowing where and how you can play and react and position the fund, which are ultimately representing your investors' bet and investment into infrastructure. Important to share a bit how you think, where do you position, where you respond, so that when we're all watching markets, they've got a bit of a line of sight into the brain that is behind Dave Wahl and the ClearBridge crew as a part of Franklin Templeton. So it's actually great to see and good exposure for our audience. I appreciate you sharing it.
Yeah, good.
Thinking about themes and opportunities in the market and a bit where we're headed, some of the things we've seen evolve now, thinking about decarbonization, global utilities, you've got a 5G revolution. You talked a bit about listed versus unlisted in your discussions.
Yeah.
Can you highlight a few stories within the portfolio that might be interesting to share with the audience?
Yeah, I can. And I'll just put those up. Those are what we talked about as the list, so people can take a look at that. Obviously, we can't go in depth on all of them, but I mean, for interest's sake, and I think it's probably a popular topic right now, let's talk a little bit about decarbonization and global utilities. So in the utility space, there's two sub areas, and that's transmission and distribution. Again, not the unregulated generation. We're just looking at the transmission distribution. In distribution, and that's essentially poles and wires that bring the electricity to our houses, we're seeing these companies earning 9 to 10.5% return on equity that they have in their projects. Some little examples that might resonate with the people on the call. There's a ton of capital being spent already to ready the grids for electric vehicles. For every 2 electric vehicles you add, it's like adding 1 house to a service territory. That's astounding to me when I was reading that. and I'm sure it's astounding to everyone on the call. So there are going to be a lot of upgrades needed. And this is in line with public policy. So regulators are signing off on all these expenditures, which allows utility companies to recoup those expenses and earn a return on their investable base. On the transmission side, and that's the high voltage wires that carry electricity a long way. U.S. projects are regulated and earn 10.5 to 12 on the equity in those underlying projects as well. There's massive investment needed here to meet the net net zero by 2050. You know, Princeton did a study, I think it was last year or early this year. It doesn't matter, but they think by 2030, the U.S., as an example, needs to extend their transition network by 60% in terms of gigawatt miles. I know that's maybe mumble jumble to me and everyone here, but the real number is increase the network by 60%, and they need to triple that same network by 2050 in order to meet net zero. So by 2050, we'll be generating at least double the electricity in total today. That means we're going to need a ton more power sources, and we're going to really have to expand transmission. Today's transmission, just as one more little trivia, today's grid took over 100 years to build and will need to at least double its size in the next 15 years and then add as much again in the following 15 years. So, you know, at least $2.5 trillion in incremental dollars beyond investment and usual business. And that's got to be deployed by 2030 to reach 2050. And that's just a staggering amount. And listen, on the renewable side, so that's the global utilities. From a decarb side, the U.S. Inflation Reduction Act was a huge deal. We were fortunate enough to speak with the CFO of NextEra Energy, which is one of the premier renewable companies globally. And he just said that that's industry transformative. He really said that he doesn't see why any company would build anything other than renewables from now on from an economic business perspective. And they're really excited. And just a couple of points around that. A lot of that idea that he's talking about is tax credits and production tax credits for solar, wind, and they're available to 2032 or until 75% reduction in greenhouse gas emissions off current numbers. Many think that that's not going to be a 10-year period. That might be a 20-year period. So really extends that visibility and the ability to build out those types of projects. And another one is that any utility that's relying on coal is very incentivized now to move away from that. Regulators are allowing those companies to depreciate the coal plant over time rather than losing that financial benefit if the plant's closed. So losing that benefit would make closing the coal plant early unattractive. Now the opposite is true. They're closing them early. The downturn to that is we as the consumer will pay for that depreciation, but in the long term, from a ESG perspective, it's very well received. You know, and recovery, that's really our user pay names. Obviously, they're not where they were. There's a long runway. We think even if today wasn't going into an uncertain economic time, 5G evolution, that's really the talk around everybody has to have high-speed internet and the build out around that. And you know, companies clamoring for space on the towers. Enlisted versus unlisted, the private companies are valued much higher than our portfolio from a multiple perspective. We think that's going to, we think that that multiple gap will decrease, not by them coming down, but more so us being able to have multiple expansion.
Well, the one thing among many that really caught my attention, one that nugget about a car charger at home being the equivalent of a house showing up on the grid. That's something that is very clearly going to drive demand. That's crazy.
Yeah.
And it kind of makes sense when you think about how quickly you can charge your car, but you don't really compute it as, you know, this is another building on the grid, even though it is. Mm-hmm. The second thing, so that's driving demand. The second thing, you've got supply side, both private and government working together. Obviously, the tax credit initiative you mentioned in the conversation with the renewables company, when that kind of cooperation happens, you ultimately guide a pathway and incentivize a company to respond in a specific way. The fact that that's happening, being recognized, that is actually a tremendous motivator and driver to get to what is ultimately becoming a clean energy environment where we can all operate, and the infrastructure that goes with it, a large part of that transition.
Right. Agreed.
Fascinating. Now, I mean, we've got a diverse group in our crowd today. We've unpacked a boatload of information for folks to contemplate and consider. Investors obviously speak with your advisors where you have them, but for the advisors themselves, how do you make this fit into a portfolio? How are you sharing, or how are you suggesting your advisors share it with their clients as a means of getting invested into the infrastructure space?
So this is my rubber hits the road slide. So much fire hosing was done on information. I hope that people were able to consume parts of that anyways and get a feel for it. But really, how does it work in a portfolio? So what we did was we took a Canadian balanced portfolio, 65-35 equities to fixed income. And we looked at the return and the risk standard deviation graph on the right-hand side. And that over a 10-year period to the end of the end of last year, so December 2021, came in that square blue box in the middle. And what we did was we said, okay, what if we took 15%, and I'll illustrate that one, but we took 15% away from the equity side, left the fixed income the same, and we allocated 15% to global infrastructure. How would that change the portfolio? And over the 10-year period, what it did was it improved return and reduced risk. So, I mean, everybody on this call for sure knows that if you're looking at this type of graph, you want to be in the upper left quadrant. So by moving from that square box to that teal circle, that's adding 15% just to the equity portion of your portfolio. It's really, again, like I spoke about at the beginning, taking those equities and de-risking a portion of them by putting them in that less volatile infrastructure space.
So in effect, some de-risking going on, which is interesting as you move back to more stable and certainly well-coordinated long-term investment thesis. You nailed it on the head. Lower risk, high returns. That's always the objective for an advisor. So in effect,
yeah, it seems to work.
Absolutely, very, very interesting. So, you know, thinking, and time flies when you're having fun here. If you were running out of a room and you just finished a meeting like this, or you had one thing left to share with our audience today, as they're, you know, kind of perhaps commuting home or driving home from work, or taking the train out of downtown core back home using infrastructure, what would be your, hey, if you're on the fence, this is why you should really consider infrastructure, never mind everything else you've told us already?
Yeah. Well, and you alluded to it about 5 minutes ago, Eric, when you talked about policy and government and the like. So when I look at it overall, and we can go back to the characteristics that are there, and I think they're, you know, that solution that infrastructure fits a lot of things. And I think it is a solution for most investor needs. It's really hard to navigate currently. And you know what, most people, whether you're investing for yourself or you're an advisor, you just don't want to be wrong. And I think this is the opportunity to take an equity position where you're not going to be wrong over the long period of time. Sure, there's moments in these markets that are really uncertain and volatile that we don't know what's happening or why, but over the long period of time, I think infrastructure addition would be great. And, you know, you haven't missed infrastructure if you think that going forward. And I think infrastructure is a good long-term investment for those contemplating the class. And this is why, and you alluded to it: public policy, fiscal policy, and a secular growth story. And I'll just give you a couple of tidbits. So from a public policy perspective, from a layman's terms, you always want to invest alongside public policy. And right now, we need energy security. And to do that, you have to build a whole ton of infrastructure. You know, we have high gas prices and supply constraints, you know, brought on by Russia, Ukraine, and that's really highlighted the importance of energy investment and security. And over the next decade, we're going to continue to realize just how important it is to have energy security. Europe, UK are figuring out as well. You know, they want LNG, and that's an important transition for them. Those liquefaction facilities are important for us in North America, so we can get the gas over to Europe, so we can all have that energy security. And there's a ton of pressure for greener policies and the push for net zero. That's going to continue, and that'll drive government investment. So that's public policy. Fiscal policy, you don't want to fight fiscal policy. You want to invest where government money is going. So they're setting policy, but they're also investing there. And listen, President Biden says he wants to reduce emissions in the US by 50% by 2030, half the power coming from solar plants by 2050. If we add it up, it's going to take 40 to 100% more electricity to accomplish that. And that's going to take a lot of renewables in the decarbonization space. And we talked about the US Inflation Reduction Act and how, you know, this is industry transformative. So finally, and I think the last part, and it goes to the themes and trends we talked about, that there's a dire need for infrastructure spending, and that's going to underpin growth for the next decade and beyond. So, you know, structurally, we think there's going to be higher rates and inflation, but 90% of our cash flows in the portfolio are either directly or indirectly linked to inflation. And when these companies go back to regulators, their allowed returns are reset to the prevailing bond market. So they have a pass-through of bond yields on a medium term, not maybe right away, but on the medium term. And the US is going to need interconnected high voltage grid to make net zero possible. You know, we talked about the $2.5 trillion. You know, it's going to take 320 billion invested in electricity transmission infrastructure to meet net zero. There's an allocation from the US IRA of 350 billion of spending to zero carbon energy and emissions reduction technology alone. We talked about that 1.2 trillion through 2035. You know, US IRA is also going to help battery storage capacity by 5 or 6 times over the next 5 years. Not an area we invest in, but without all that new investment in transmission infra, a lot of the power that is going to be stored in a battery is going to be trapped where it's generated. So, you know, all of those things with those characteristics, you know, in an uncertain economic time, I think infrastructure is a great investment for investors, advisors, institutions alike. So I'll leave it there, Eric. Thanks for having me along. And I know I probably bumped us up too close to time, but I'm happy to have been here.
Not in the slightest. It's an incredible opportunity, frankly, and one that is definitely worthy of the extra time and consideration. And certainly for investors, if you haven't looked at where infrastructure is fitting into your portfolio today, now probably as good a time as any to take a look, given the longer term investment horizon needed to make much of this infrastructure come forward. And Dave really hammering home the point, like this is a coordinated effort across investors of all types and government and policy, and ultimately a forward look on our kind of the way we look at the global economy coming through infrastructure. So it's a pretty incredible time to take a look at this in the early stages of some parts of the sector, certainly in more established areas of others, and one not to overlook, certainly. So Dave, you put on a masterclass for us today on why investors, advisors, and frankly institutions are and should be seriously watching and looking at infrastructure to fill their portfolio. Somehow definitely out of time for today. I feel like we could have another hour or two conversation on each of those verticals in the slides.
Sure. Yeah.
But on behalf of our audience, the team and I here at the NEO Exchange, and certainly the Canadian ETF market, I'd like to thank you for taking the time out to bring us up to speed on this opportunity. And definitely eye-opening conversation. So thank you very much.
Yeah, thanks. And thanks for everyone's time. I appreciate it.
Absolutely. And to our audience, thanks again for joining us for another NEO Spotlight, today focused on infrastructure in volatile markets. We hope you came away with a few investing ideas and thoughts on our discussion with Dave. If you've got any questions, Dave, while accessible, is probably not the right destination for Q&A. Feel free to reach out through your Franklin Templeton wholesaler or national accounts. I'm sure they will happily respond. If you have any additional questions you didn't think of, feel free to send it on to the NEO team, and I will happily forward it through and make sure somebody comes back to you quickly. That said, this is NEO and the Canadian ETF market and ClearBridge and Franklin Templeton signing off for today. Have a terrific day, everyone. Thank you so much.